That's all that. You have to sense that thing. And they actually sell the CBS book for, there's an online study. And they sell it in the
All right, good morning.
Good morning.
Gonna let people start coming in. How's everyone's weekend? Good? Productive? All right, we're starting to get to the end of class here. Okay, we're starting to get to the end of class here. So hopefully you get to that point where you're ready to take the exam and start doing some commercial real estate. Not next week, but probably the week after. Okay. So let's target. Let's target the 24th for our exam date. Okay? The 24th is our exam date. All right? Now the 24th is a special day. So the 24th, we're going to start 1 hour early. Okay? So the 24th, we're going to start 1 hour early. So instead of starting at 11, we're going to start at 10 a.m. Okay? The reason why we're going to start at 10 a.m. is because since you're going to be here anyways, all right, since you're going to be here anyways, I'm going to turn it into a company compliance meeting as well. So it sort of kills two birds with one stone. Make sense? Yes?
What's that about?
Okay, so Tuesday the 24th, if you hear me sending out voice blasts and emails, it's going to be the date that we're going to take our exam in class. Okay, so for all the people, we need everyone to come and take the exam live. Okay, because I just don't send it to you where you can take it from home and then send it back. Okay, there's a time limit to it. All right, so for those of you who are online, I know a lot of people take the class online, but for one day, online or not, try to make it here. Okay, so we're gonna be taking the exam on that day at 10 a.m., not 11. Okay, it's gonna be at 10 a.m. Yes.
Is it going to be on the computer or on paper?
No, on paper.
On paper.
Okay, on paper. Because I'm gonna have, just an idea. I might give you a contract to fill in. Okay, I might give you, and a lot of it is written. It's not really multiple choice stuff. Okay. All right. So you can't guess. If you know, you know. You don't know, you don't know. All right. So it's not guess a letter or 25%. It's not eliminate two, guess. No, you got to know, okay? So a lot of it's writing. It's like almost like a real exam where you need to know it, okay? All right? So
Do you recommend to read something else besides the...
no, just read the notes that we've gone over with you. You should be fine, okay? It's not rocket science. If you were to take a real estate class on how to write up a contract and someone put a contract in front of you, you know how to fill it in, right?
Oh, yeah.
It's like, right? If I ask you what's an agency disclosure, you can tell me, right? You know what I'm saying? If I ask you what a transfer disclosure statement is, you can tell me what it is. Same thing as commercial real estate, okay? So it's just some general knowledge, all right? So it's going to be, we're going to double up that day and do a compliance meeting as well. So you'll arrive at 10, but then the rest of the agents will probably come in at around 11 for our compliance meeting, all right, or 11:30. You'll probably have an hour and 15 minutes to finish your exam, And so to tell you, if it's only a test, it's only hour and 15 minutes, so it's not like a 3-hour exam, okay? It's there's not too much I can test you on, all right? So it's not going to be, studying for Department of Real Estate agent exam or anything like that. So don't, I just need to know that you can get out there and survive. You know what I'm saying? Because your first 3-4 transactions, I do them with you anyways, or your mentor would anyways, okay? All right? We're going to do a compliance meeting starting at around 11:15 on that day. And at noon, we have a special guest speaker company coming in, and they're actually flying in to go over non-QM loan programs. Okay? I think it's a very powerful class for you to take on non-QM loan programs. The reason why it's very powerful is because on September the 24th, you're going to be learning about all the new loan programs for clients that normally wouldn't be able to get a loan. Now they can. Make sense? Because see, this is what happens. All right, and so I want everyone to understand something. Okay, this is what happens. Okay? Okay? All right, this is what happens. If this is all the people, all the families that are on the market, technically, you have maybe a third of the people out there that qualified for a paper. That qualify for a paper financing. Okay? There might be another third that qualifies for some type of government or A- paper financing. Okay? All right? And then there's a group of people here that for now don't qualify. The masses chase after this business. Does that make sense? The masses chase after this business. Okay? The first-time home buyer programs, the government, FHA loan program, the government's VA program, the USDA program, the CalHAFA program, the financial assistance programs. There's a big group of people that go after these people too. But there's a whole segment of the market of people that want to buy, but they don't know how to buy. Does that make sense? Well, this coming on the 24th of September, the reason why it's a very important class for you to take is that we have one of the nation's largest they call it non-QM lenders. A non-QM, I mean non-qualified mortgage lenders. That means that they specialize in working with clients that fit into these two categories right here. Everything outside of A paper are these two categories right here. People who don't qualify or people who are close but no cigar. Okay, they're in the close but no cigar category. Okay? They're in that program right there. This program, the non-QM programs, are people that are from foreign countries that are non-resident of this country. Programs where there's business owners that file no income or file losses. Right? People who have a lot of money down but nothing else. Okay? People that have absolutely terrible credit.
But isn't that the trend that got everything in trouble back in 2008?
Yeah, but in 2008, what got people in trouble was there were no nothing loans. No income, no no asset, no income, no asset, barely have any credit, and putting no money down, you know what I'm saying? That kind of stuff, you know? Whereas now there's nothing like that. There's collateral-based loans, there's income-based loans, there's credit-based loans. You know, does that make sense? So we're gonna go. You know, it's funny. Since you asked the question, you know what caused the collapse in the economy? One of the products that caused the collapse in the economy was the pay option arm.
Yeah.
The pickup payments. You know, the 1% neg-am pickup payment loans. That caused the collapse in the economy. Okay? And everyone was offering it. That was the thing. A huge percentage of loans during that time was the pay option arm. You know, the pickup payments. Right? Do you know that actually loan wasn't meant to be a bad loan? It wasn't meant to be a bad loan. But the people that sold the loan sold it the bad way.
Right.
Okay? Because technically, okay, let me explain to you in the best way you could have explained that loan, 15 years ago. Okay? The loan was a very flexible loan. It's called a pay option arm. The loan, when you got the loan, you got 4 loans in one. 4 of them. Okay? Because when you got the loan, you got 4 options. Are you recording? Mm-hmm. You can't record. Okay. But you can listen. But so option 1, and tell me if it's good or not, okay? Option 1 is that it was a 30-year fixed loan at a pretty decent rate. Option 1 was a 30-year fixed loan. The 30-year fixed loan at a decent rate is supposed to be the loan, the first option. That's the loan that you pay on when everything is normal in your life, right? That's option 1. Option 2 was a 15-year option. Option 2 is when you're at that stage in your life where you had extra spending money and you wanted to pay your home off sooner, and you had some extra money, so then you would choose to pay that option when you had some extra money, extra bonus, extra overtime, right? So when you had extra money, you'd pay on the second option, which is the 15-year option. Option 3 was meant for little uh-oh moments in your life. Option 3 was an interest-only option, where there might be a month like Christmas, and there might be a month where your car broke down unexpectedly, and there might be a month where your daughter needed braces, and you spent a little extra money, and you needed a little extra money for the month. That's all. So the uh-oh moments, you could choose in your 4 options to pay an interest-only option. Can you turn the air on, Sister Juden, more? Some people are hot. Okay? So that's called the interest-only option, right? So instead of having a $3,000 payment for the month, you only had to pay $2,000 for the month. Whatever. That make sense? Okay, so that was the interest-only option. And then option number 4 was there was a financial disaster that happened that month. Okay? That's called the 1% minimum payment option. Similar to a credit card. You know, like when you get a credit card, the interest rates are pretty darn high, right? Technically, you're supposed to pay with your credit card and pay it off at the end of the month. Does that make sense?
Right.
Because, like for example, all of my credit cards, I refuse to pay interest. So what do? I have it already set up with my credit card companies to automatically debit my bank account everything that was owed for the month, every month.
The whole balance.
The whole balance. Because I refuse to pay interest. Because the interest rate is like 13, 14%. Who wants to pay that? I don't have to use credit card then. I'll just use a debit card. Okay? But the reason why I use the credit card is because every time I purchase something, it gives me like 2%, 3%, 2%. Right? So why not save 2%? So what, right?
Or the mileage.
Okay, or mileage or whatever it is. Okay, so I don't mind. But I do mind if something happened and they didn't pay it and then I have to pay 14% interest on that. That's no good. Because you say, well, if you do that with your credit card company, don't they hate you? Because they're not making any money from you. What you don't understand is they charge the vendors like 3%, 3.5% every time the vendors take your money. You guys understand that? When you go to somewhere and you pay $100 for a credit card purchase, the vendor that sold you had to pay like $3 fee to your credit card company for using that. Does it make sense? Okay? So they make their money. When you purchase something, they make their money already. Right? Every month, if I spend $10,000 on my credit card to run it through the company expenses, they'll make $350 from me, no matter what. If I don't pay off the card, they make an extra interest rate. They hit the jackpot. But for most of you who pay your minimum payments, they're hitting a jackpot from you. Because when you buy something, they make money. And then of course when the balance sits there and you pay interest on that balance, they make more money. Then they hit the jackpot from you. But they're not going to hit the jackpot from me, okay? All right? So because of that, that's how they work. So in the lending industry, so as we're talking about that, you know, you sort of got to just understand how the system works. So in the pay option arm, you're supposed to pay 1% in a financial disaster. The option arm was supposed to be 1%. You make that payment when it's a financial disaster, where your mortgage payment's supposed to be $3,000, but you only have to pay $300 because that month was just a big problem. The problem with the mortgage industry at the time is people got loans based on that financial disaster. People got the loan thinking that their 1% payment was what they wanted to pay forever, even though that was only an option for the only first 1 or 2 years of the loan. You guys understand that? So people's mindset was, oh wow, I should only buy a $300,000 house, but boy did I love that $700,000 brand new house. Pocket-wise, they really should have bought a $300,000 home. But they decided, I'm going to buy a $700,000 house. Because they said, I can afford a 1% payment. This $700,000 loan with a $2,000 a month payment? Oh yeah, I want that. So the government that pick-up payment program gave people the ability to go into something that was 2 or 3 times more than they can afford. And then they said, well then, if that's the case, how did they afford it? Because they had a program called stated income. They allowed a program where you just basically make up what you made. I mean, you just have to make it up. Think it out of clear air. How much do you make? You look at your bank account, you're depositing $2,000 a month in income, and you also need to tell them, I make 20 grand a month. And they have no questions asked. That's the problem. A lot more people call themselves owner of landscaping companies and bought 10 houses. Because you know what they thought? They thought that, hey, this payment, this $500,000 home payment, $1,500. So I'm going to buy 10 of these homes. And I'm going to rent each of them out for $2,500 and make $1,000 per home per month. And I'm going to make $10,000 a month in income from owning these 10 homes. And then I bought these homes for $500. In 2 years, it'd be worth $700. So since I have my pay option arm minimum payment for 2 years, I'm just going to rent it out for 2 years, right? make $10,000 every month for 2 years. That's $200-something thousand. And at the end of those 2 years, my $500,000 home is worth $750,000. I'm going to sell them all, and I'm going to end up making myself $2 million. You know the people that sort of started that plan when the property started going up, they actually made a killing. You know that? There were people that would buy 10 new homes from a builder. Okay, when it first started, they'd buy a home at $300,000. By the time the home was done, it was worth $500,000. And they made millions because of that crazy frenzy. But then like a bad Ponzi scheme, the people that bought it right before the collapse, the millions of people that bought it right before the collapse, the home didn't go up. Matter of fact, the home went down. Then that option that plan don't work no more. And then so only option, walk away. And that's why there are all those foreclosures, right? Well, the thing is, that's not going to happen again because for the last 10, 12 years, the mortgage industry changed. They eliminated all of those types of loans. Does that make sense? The pay option arm was not supposed to be a bad loan. It was supposed to be a 30-year loan with 3 options other than the 30-year loan. But those were supposed to be short-term or just options when it was a problem. When you had extra money, you pay on the 15-year option. When you had a little bit less money than normal, you pay on the interest-only option. When it was a financial disaster, then you pay on the final option, the minimum payment. But people went into it thinking minimum payment only. That's what happens to people who get into deep credit card debt. Just tell you, that's what happens to people that get into deep credit card debt. You buy things on credit. You're thinking to yourself that, hey, I buy this $10,000 luxury item, and I'm only paying $100 a month. I can afford that. What you don't realize is that's the minimum payment, but everything else that you borrowed is being charged like a 14% interest rate on it, month in and month out. And you see this $10,000. This $10,000 credit card, get the $20,000 in a year. You guys understand that? And you keep going backwards, more and more and more. You keep going backwards, and that's the sadness of of people that get into that kind of credit card debt. It could be some of the people in this room.
But investment bank, those loans who are very successful.
What?
I know one Remax Gold guy. He bought 170-80 home and he sold at the peak. Then he bought 2 apartment complex.
Yeah, I mean that's what I'm saying is that sometimes you get lucky. You know what I'm saying? You time the market right and you get lucky. But for the handful of people that get lucky, there's 10 handful of people that find themselves very unfortunate. Does that make sense? And I got stuck in that. Okay. All right. So we're going to go into commercial lending now that the majority of people are here.
Recording this?
Huh?
You're gonna record this?
I record this all. That's why you don't need to record me because we have all the videos already.
Okay.
But you record me at a bad angle or something, all of a sudden you have the thing, and all of a sudden I find myself on YouTube. Public YouTube. Even though this is private class, I find myself on YouTube. So that's why I just don't record it. Not because I don't like myself, but it's just All right, so today we're going to go over commercial financing. Okay, we're going to go into some detailed stuff. I pulled this up right from a website. Okay, it doesn't mean that you go to this website to use them. All right, this is just a general site, but it's just public information out there. I thought that I thought it was good, so I decided I'll just go ahead and go over it with you. Okay, now there are a handful of commercial lending products that are out there, okay? And today we're going to go over what those products are and why they're good, why they're not good, okay? But I'll tell you, when you work with commercial clients, you need to understand the type of financing that's out there so that you can help the client. Make sense? First type of loan is just a traditional commercial loan. It's a traditional commercial loan. Right here. A traditional commercial loan. All right. Traditional commercial loans are not 30-year loans. Okay? In the commercial industry, commercial loans don't go out typically more than 5 to 7 years. Okay? So for people that do commercial loans, in a way it's good, is that every 5 or 6 years the client comes back and refinances every 5 or 6 years. So in a way, commercial loans is pretty decent that way. Okay? We can do commercial loans here. Actually, we have a big mortgage company. We can do commercial loans here. We're licensed to do commercial financing. Okay? So, and the crazy part is, here's the crazy part. If you work for a company that can do commercial financing, your real estate license that you have allows you to do commercial financing too, just like commercial real estate. So here's sort of the crazy part. I'm not telling you go out there and be a commercial lender, but what I'm trying to tell you is, okay, that when you work for a company like ours that does commercial financing, you do not have to get your mortgage license in order to do commercial loans. You guys understand that? Okay? Because, believe it or not, the NMLS, National Mortgage Licensing System, and the MLO endorsement, that is actually for you to do, okay, residential loans from 1 to 4 units. Make sense? Okay? That's the residential mortgage, ability to do residential mortgages. Commercial mortgages, the license that you need to have is the license you already have, which is the real estate license. Okay? That's good news, right?
Great news.
Okay? But you have to be with a company that the company is licensed to do that. And we are. Okay? So because of that, that's one big feather you get to be able to put in your cap, that when you're working on a commercial transaction, you could actually help take part in the commercial financing of it and make a commission. So when you're doing those types of transactions, you are reaching in more than one cookie jar. Does it make sense? Isn't that awesome?
So who makes the one?
No, we just go through the banks and then the banks pay us, okay? We just become information gatherers, all right? That's how it works, okay? Does it make sense?
What about
Okay.
agent is buyer?
Huh?
What about agent is buyer for the commercial property?
If the agent is the buyer, so you're your own buyer,
Yeah.
it's fine. I mean, if we go to one of our lenders and the lender pays us, then you get a portion of that too. Okay? All right? So now there's more of a reason for you to pay attention, right? Okay? Because technically you could actually, help in that process. Okay? You can help in that process. All right. So the first type of loan that people get is the traditional loan. The traditional loan. Okay? A traditional loan, okay, can come from the local banks like the Wells Fargos, the Bank of Americas, or a lot of times for commercial lending, you have to go to the smaller banks because they will be a little bit more untraditional in the lending side of things. Okay? So when we work with clients, sometimes we will send them directly to whoever their banking institution is. So they could go directly to Bank of America, directly to Wells Fargo, and they can get a loan from them. The problem with that is, okay, the problem with that is that the guidelines for the main big box banks are very strict. Okay, the guidelines are very strict. So there are loans that if the client is a little bit off, then it's the local banks that offer the best product for the client. The local banks that offer the best product for the client. So example, let's say Sacramento Community Bank. See how these banks make money? So you understand the industry? How these banks make money is that, you have deposits in the bank. Okay? The banks are allowed to borrow from the government or whoever a certain times of the deposits in their bank. So when people give you free checking and savings and they're holding your money technically for free, and then you ask yourself, man, how do these people make money off me? They're giving me interest. They're charging me no bank fees. How are they making money off me? Easy. Because banks are allowed to borrow themselves. Okay? 5-10 times what they have in deposits. So if you have $100,000 of your money on average, it's called average daily balance, right? If you have $100,000 of your money sitting in the bank can borrow 10 times that. And so to them, the bank is now leaning on the $100,000 you keep in their bank, and they're borrowing $1 million, and they're lending out the $1 million to people who want to buy buildings. You guys understand that? Right? Or they lend out money to people that want to buy homes. So imagine if you had $100,000 of your money in the bank, on average, and they lend out $1 million because of that money sitting there. They're able to borrow from the government at whatever, 2%, and they're able to lend out to a commercial developer at 8%. They made 6% of $1 million because of your $100,000. You guys understand that?
Yeah.
You get that? They made 6% of $1 million, which is $60,000 a year, from your $100,000 just sitting there. That's great, right?
Damn, yeah.
For them. You see? So banks, they love your business. They love your average daily balance. Because they can borrow from that average daily balance. So technically, they're not lending your money. They're using your money as collateral to borrow money from a bigger institution. And they're lending that out. Does it make sense? Okay, that's how it works. So that's why they love it. When you keep $10,000 on the bank, that means they're lending out $100,000 to somebody. You see? Okay? On money that they sort of use the average day deposits as their collateral, as their business collateral. Okay. So how traditional loan programs work is normally the interest rates are pretty decent. So the first type of loan is the traditional loan. These loans normally carry a little bit lower interest rate. Okay? They normally carry a little bit lower interest rate. All right? These days, if you could get a Bank of America loan or a Wells Fargo loan or a Chase loan, you could get in the 4% range.
Commercial?
Huh? Commercial. 4 to 5% range. And the fees aren't that bad. Maybe 1 point plus processing and stuff like that. Okay? But the loans really aren't locked for a long time. 5 to 7 years. And after that, it goes adjustable. Okay? And when it goes adjustable, then it's based on the market. Okay? A margin, a market. Okay? And then that's how those work. Okay? That's how those work. Okay? And the traditional loans, it says here 6.5 to 30% rates. Right now the rates are low, so it goes less than that, 4.5%, 5%, all the way up. Okay. Some banks, as said, offer 10, 20, 25-year repayment periods or amortization periods. That means that you could have a loan that's due in 7 years, but it's amortized over 25 years. Okay, not the 30, but it's amortized over, so your payments aren't all crazy. Okay. These type of loans are very versatile. Okay, and when I say very versatile, these are the first place that you go to look for loans if you're like a normal business owner, is because they'll work with you. It's common sense financing. So let's say maybe in the past you've had some bad years, maybe even you have in the past even a bankruptcy, maybe some short sales or foreclosure, maybe you've had credit issues. These community banks will work with you. The big major box banks, they won't work with you. Okay? How it normally works, how we get paid, okay, is some programs, like say, example, let's say a community bank, if someone were to go directly to community bank, the community bank will charge them 1 or 2% of the loan amount that they're looking for as the bank's fee. Does that make sense? If we bring the loan to the bank, then the bank sometimes, well, most of the time, they don't charge that fee. Then we charge the fee. So even though it looks like we're charging the client would have been charged. You understand? So the client walked straight to the bank and said, I want to get a loan. And the loan officer who's working there, worked on the client's loan. Then the loan officer would charge the client 1 or 2% plus their processing fee, and the client would get the loan and pay that. If we brought the loan to that bank, then the loan officer from that bank is no longer working with the client. Does that make sense? So in that case, they don't charge that fee, or they charge a reduced fee. So they say, well, our normal bank charge is 2%, but if you bring them, then we only charge 0.5%. Well, then if that's the case, we'll be looking to make 1.5%. So we don't charge them more than what they would have paid for, necessarily. We could, but that's normally how it works. Does that make sense? Okay? That's for a normal conventional financing. All right? So when you're writing down on loans, the first place normally that we would go to are the local banks that do normal conventional financing. Now, not only do the local banks do normal commercial financing, but we also work with the big lenders, the conduits, the big ones. Okay? So I have access to the big ones. U.S. Bank, Zion's. I don't know if you've heard of Zion Bank. When you are in the commercial industry, Zion Bank is one of the nation's top 2 or 3 lenders in the whole United States for commercial loans. Zion. Okay? We work with Bridge, So there's big time commercial banks that no one has ever heard of before, but they're the biggest. And so we send business their way as well. Does that make sense? Okay? But the big ones are going to be more strict, or the big ones have a specialty to them. So for example, we work with banks that specialize in hotels, or there's some banks that specialize in office or retail. There's banks that specialize in gas stations. Does it make sense? And those are the only type of loans they take. All right? So the most important thing normally when we run into a client, and I'll go over it with you in the financing part of it, is we always collect a very standard list of things. Okay? We always normally collect a pretty standard list of things. And then we take that package and we send it out for the lenders to look at. Does it make sense? Okay? All right? So those are traditional lenders. Okay? Those are the traditional loan lenders. Okay? How to qualify No, here's the thing. When you're dealing with, okay, when you're dealing with a traditional loan, they look at more factors than just a normal loan. You know, does your credit matter? Yeah, your credit always matters. They want to see how you are. Does your income matter? Yeah, they don't want you to be broke. Okay? Does your job matter? Yeah, I guess so. But you know what matters the most on a commercial loan? Huh? What you're buying matters the most. Okay? Normally what you're buying matters the most on a loan. Because when the banks look at it, what they're looking for is, in worst case scenario, we're going to own this. You know, what are we going to do with this if we owned it? You guys understand? Okay? So if you bought a shopping center, they're going to say, okay, well, if we own this shopping center, is it worth it? If you bought a warehouse, well, if we own this warehouse, what would we do with it? So the property itself, so it's funny because there's been times where the deal was so good that the client had to put very little down. It was just such a good deal. Now, the banks still want you to have skin in the game. Meaning they'd still want you to have some of your money into it. But in commercial financing, you know, it's not the 5%, 3% down stuff that you're talking about unless it's government, okay? But if it's a good deal to the bank, you put 20% into it, and it's a good deal, they're cool with that. 25% down, okay, cool with that. If it's really not that good a deal, then you might have to put 50% down. Make sense? So they look at the deal. Where in residential, it's just, hey, we have a 5% down program. They won't care what home you buy as long as the home appraises, right? Commercial is not like that. The numbers for the the banks, they have to like the project too. Does that make sense? The banks have to like the project. Okay? So there's something in the commercial industry called an executive summary. Called an executive summary. All right? And you'll have to learn what that is. And basically, it's a summary of the project. What are you buying? Oh, it's a 60,000 square foot shopping center that's 95% leased out. This is the income. This is the cap rate. We feel that's even worth more because this is the money that we're going to put into it. This is the income that we're getting. This is how strong the tenants are. Yeah, no-brainer, right? Long-term tenants with long-term leases, good income. These tenants are credit tenants, Starbucks, Jamba Juice, Chick-fil-A, Safeway, Bel Air, Nugget. Oh, bank will lend on it all day long. And you put 20%, no problem, right? But half vacant, tenants aren't very good. Oh, you're going to have to put 50% down on that puppy. Does it make sense? So that's how commercial lending works. So when you go into a commercial loan, one of the first things we collect is a summary, an executive summary. What do you need the money for? Tell me everything about the project. Make sense? All right? Tell me everything about the project. Because how lenders work is everything works in committee. Okay? So the bank, so picture the bank, when they have their meetings every week, new loans are put on the table, and then it basically is done like the old-fashioned way. Hey guys, we have this new loan, this guy, he seems like a pretty good operator, he's looking for a $5 million loan because he's buying this $8 million shopping center, he has $3 million of his own money, all in the bank right now, so he's looking for a 60% loan to value, this is the shopping center, it's this many square feet, it's in this area, and then, the committee sits around and says, yeah, I like this deal. I like this deal. Does that make sense? And they say, okay, well then let's find out more information. Let's see. Let's get all the. So that's how they do it. That they do it via committee. That's how it works. Okay. Not like everything done, desktop underwriters. It's not like that in commercial. Okay, commercial, you deal with a lot more people. Common sense. Right? Common sense. You know? It's so crazy. I did a commercial loan before with a big box lender. I did a commercial loan before. Everything was approved. Everything was approved. Every single thing was approved. And the only thing we needed was a signature from the chief credit officer. And the deal was done. Guess what? The chief credit officer decided he didn't feel like signing it that day. And 3 months of work went down the drain. They just declined it. Everyone approved it. The committee approved it. The underwriters approved it. Everyone liked the deal. It had to go to a chief credit officer, and the chief credit officer had a bad day and decided not to approve it. You know why? The stupidest reason. On the initial loan application, the question was, has the client ever filed bankruptcy? The client filed bankruptcy 25 years ago when he was a young business owner. And he had a small business that didn't work out. They filed bankruptcy 25 years ago. It didn't even show on the credit report because it's been more than 10 years. It didn't even show on the credit report. All right? And the client, he had his assistant fill it out. And so his assistant knew his credit, saw the credit report, didn't see anything, so the assistant filled it out, and she marked no. When we came down to closing, they pulled the background search that went beyond the credit report. They pulled a LexisNexis, and that thing showed up 25 years ago. They got a letter of explanation over to the underwriter, the committee. Everyone was okay with it. The only one that wasn't okay with it was this one chief credit officer from on the other side of the country. Didn't even know the whole file. And they said, no, I'm not going to do it. Boom, that's it. Luckily, I saved the deal. I just took the whole package to a different lender, ended up getting my client even a better deal, actually. And so I saved it. But the thing is that, we're in this business, we deal with people, actually. You know what I'm saying? Someone has a bad day, man. So that's the thing sometimes, you know what I'm saying? Or sometimes someone has a good day. It was funny because there was a lifesaver for a client of mine. A lifesaver. The client was doing a construction financing. And when the construction financing was due, okay, we could not get the loan put through the permanent financing. But, and the person that declined us, 3 or 4 times, we were like, oh my God, we're going to lose the whole project here. And lo and behold, at the end of the month, the company that declined us 4 or 5 times, they just had a deal that sort of fell out and they needed to lend the money. So they call and say, hey, if you need the money, we'll go ahead and approve you right now. I said, yeah, we still need it, of course. And then boom, they approved it and then everything went fine. Okay, does that make sense? So sometimes if you get in front of the lender at the right time, the committee might have turned it down 4 or 5 times before, but a good month came up, they have extra funds in the bank, they needed to meet their quota for lending, boom, they'll just give it to you. So we just really lucked out. They took it. You know what I'm saying? Okay? So yeah, those things happen. All right? So how to qualify. In a minute here, we'll talk about how to qualify, but executive summary is important. Okay? All right. So we're going to go pretty fast through the different loan programs, and then I'll show you what we need to collect. Okay. Next one are the short-term loans. Are short-term loans. Okay, I'm going to talk about 2 types of short-term loans. One is just to get your business going, but this type of short-term loan okay, could also be what they call mezzanine loans. Have you ever heard of the term mezzanine? Mezzanine loan? Huh?
Yeah.
What do you guys, tell me what you know about a mezzanine loan. Mezzanine.
It's like in between, like a bridge area.
Yeah. Mezzanines and bridges. Some people call it a bridge loan. Some people call it mezzanine, a mezz. Okay, a mezz loan, bridge loan. Okay. These are basically sort of short-term loans. Okay. This is when a mezzanine loan comes into play. Okay. Example. Client is building a $20 million apartment complex. Okay? The lender, the bank, is only comfortable with a 60% loan to value. So on a $20 million apartment complex, they're only willing to lend 12. Your client only has 2. You guys understand? So the bank, $20 million loan, the bank is the main bank is only willing to lend 12. If your client only has 2 or 4, let's say 4, then he's short how much?
6.
4, right? So if your client has 4, bank's willing to lend 12, that's 16. You're short $4 million.
Seller financing.
Well, one way is you can do seller financing, okay? Or another way, well, but if the seller wants out, he don't want to finance, then the second way is you go through a bridge. You go through a bridge or a mezz loan. The mezz loan will then cover the 4 you're missing as a second, right? So they're subordinate to the first, right? So in the world of homes, it's just basically a piggyback. You get a first and a second. Make sense? In the world of commercial financing, they call it a mezzanine or a bridge, right? It bridges the gap between what you got, what the bank's willing to put in. It bridges that gap, right? Some call it hard money. It doesn't matter. Okay? Well, no, but hard money, but don't call it hard money. The reason why you don't call it hard money normally takes first position. You understand? It's like when you get a hard money loan on an investment property, they're the first. You just have to put a lot of money down and you're paying a big interest rate. That makes sense? It's collateralized financing. But in this case, it's not really hard money, it's just bridge money. You imagine a bridge. There's a piece of land here, and there's a gap in the middle. So the bridge is between the client has $4 million, the bank will lend $12 million, the project is $20 million, so there's a gap, there's a $4 million gap, right? Picture it in your brain. So then you need a bridge to bridge that gap. The bridge money is not permanent financing. Okay? The bridge money is, or the mezzanine financing is just basically the secondary financing. But it carries more risk. Right? Because they're behind the first. They're behind the first. That means if you really screw up the project and the first forecloses it, okay? Because when the bank forecloses it, the bank is going to go ahead and foreclose it for what they're owed. They'll foreclose it for the $12 million. If no one comes up to bid and someone bids $12 million, that $4 million mezzanine is wiped out. You understand? If the mezzanine wants to protect their position, they would have to buy it. You see? Does it make sense? Yeah.
Who's typically providing those type of loans?
No, there's a whole list of mezzanine lenders out there.
So, but not the big banks, but
No.
smaller banks.
Either smaller banks or just actually private investment groups. You know what I'm saying? Private investment groups. They do the bridge financing. Does that make sense? Okay.
They're taking more risk, they might charge more interest rate.
Well, that's why in here it starts at around 10%. Does that make sense?
Basically, just like hard money.
Yeah, but I don't like calling it hard money because people get confused. Hard money normally takes first position. Okay? All right? So they're called bridge financing. Okay? Bridge financing.
What is their collateral?
Huh?
What is their collateral? If they're
No,
second in line, they're
the
second
property
in
is
line.
still collateral, but they're in second position.
Yeah, so if bank, main bank, defaults in foreclosure, then they may not get their money.
Well, see, if the bank forecloses at 12,
Right.
but someone came in and bought it at 15, the bank is only allowed to keep the 12, and the other 3 goes to the mezzanine. The mezzanine loses 1.
It's higher interest rate, right?
Yeah, way higher. Okay? So when a bank is in the 5-6% range, the mezzanine is in the 10-12% range. Okay? All right? And the mezzanine is short-term loan with prepay financing, everything. Okay, with prepayment penalties and everything. All right? So that's mezzanine loan. Short-term loans, mezzanine, bridge financing. Okay, so that's the second type of loan out there. Okay? Okay?
But the loan is only about up to 18 months. That means, until the
No, it depends.
Yeah, until the project is done, that means this, buyer has to have another refinance then.
Oh, of course. So if it's under construction. Okay, so guys, hear me out. Why do we need bridge? Okay, why do we need bridge? Okay, this is why. Okay, the bridge is to allow time for the property to perform. Okay, so I give you an example. Client buys a shopping center, and the shopping center is $20 million. The shopping center is only 60% occupied, and the tenants aren't that good. So the bank doesn't like the project. If the bank liked the project, they would have lent you 80% loan to value. But the bank doesn't like the project. They feel that the project is not performing. So they said, we're okay with you. We're somewhat okay with the project if we're only, our exposure, and they call it, our exposure is only at 60%. So $20 million retail center, they just want a 60% exposure, so they only want to lend 12. You have 4. And it would have been great if they lent you 16. But they didn't. But they said, if this property's occupancy rate was at 85%, if the leases averaged a longer period of term, then we'd be willing to lend you at 80%. Right? But not yet. And the seller's not going to still wait for you. They're not going to sell at that price, if they were at 85%. So then you say, okay, that's fine. I'll get some mezz financing. So I will be okay borrowing $12 million from the bank. I'll borrow for 18 months because I feel that in 18 months I could fix it up, I could paint it, I could get better tenants, right? I could market it right? Get it looking nicer. I'll make calls to my, my commercial broker who knows all the other retail companies that might want to go in there. We'll try to get like a bank to go in there. We'll try to get a pizza place, pizza. We'll try to get a Jamba Juice in there, right? And so I think it'll take us 18 months, so I'll get a 2-year mezzanine loan. So I will get the bank financing, which they'll give me for 5 to 7 years, right? I will get a 2-year mezz loan to fill the gap, and then I'll put my own money in it. So I got a $12 million from the bank, a 2-year $4 million mezz loan at a 12% interest rate, and then I'll put my own money in. The moment it closes, I'm going to start marketing the property. I'm going to start painting it. And you'll put new roof. I'll repave it, make it look clean. Hire a broker, get it rented out up to 85%. And then 2 years from now, when everything's ready, I will refinance into a new loan that takes out the first and the second, and now I have permanent financing complete. You understand? Yes? So the mezzanine loan is meant for you for those 2 or 3 years to get it to perform. It's time for you to get it to perform. You're paying more, but if you didn't do it, then you wouldn't buy the property at all. Someone else would do it. You understand? Guys get that? See, so you're now gaining knowledge of how the business works, right? Is this important information for you?
Yes.
See, you're sort of learning how to make the deal work, okay? You're sort of learning how to make that deal work, okay? Or else you got to come up with the other $4 million yourself, you know? That's it, okay? All right, so that's, now the next one is SBA loan. SBA loan is really good type of loan, okay? An SBA loan is a really good type of loan. All right. An SBA loan has a loan limit. It's normally, how SBA loans work is SBA normally takes second position on a loan. SBA normally takes second position on a loan. When you get an SBA loan, believe it or not, SBA only funds, the SBA insured portion of it is only a percentage of the whole loan. So like for example, if you get a let's say a $10 million SBA loan, even though you call it an SBA loan, technically normally only 40% of it is the SBA portion. Okay? And the other 60% of it is actually a normal bank loan. Okay? Because why? Because SBA, when you do an SBA type loan, you can normally only need to put 10% down. No commercial lender is comfortable giving someone that is a new business owner with somewhat iffy financials, okay, you have iffy financials, no one is going to give you a 90% loan to value, right? So, when they created SBA loan, the SBA is meant for small business owners to be able to get into something that no commercial lender will ever do for you and put 10% down, okay? So, the SBA portion, for example, so if you get a loan and the loan's 10 million, if the building is 10 million and you put in there 10%, so you put in 1 million and there's 9 million left, then the SBA, of that 9 million, the SBA will cover, 40% of that was 3.6 million, and then the bank with their own funds will cover the rest of it. Does that make sense? So from the bank standpoint, they're only lending at 60%. Roughly 60%, right? From the bank standpoint, they're safe because they're only lending at 60%. And then the SBA lends the other portion. You guys understand that? The SBA lends the other portion, the other 3.6 million.
And how's the interest rate? Is it higher?
Okay, let's talk about that, okay? So the SBA program has two programs, okay? Let me show you the two programs. These are the programs, 7A and 504. There's two programs for SBA. The 7A program and the 504 program, okay? 7A is the most common SBA loan for small businesses, all right? It's the most flexible, all right? You could get up to $5 million in capital and use it for virtually any business purpose. Most often, small business owners use it for business capital. So these type of loans don't necessarily mean you have to use it for building. You could use it to expand your business even. So this type of loan could be for a lot of things. It could be for buying real estate, buying equipment, for your business, you know what I'm saying? For working capital, okay? So a 504 program, okay? A 504 program, all right, has a little higher interest rate. Okay? But it's more flexible, okay? Little higher interest rate, but it's more flexible. You guys understand that? So,
How flexible?
no, I mean you could have a little bit higher ratios. You could have a little less income. They allow for less income you make. I mean it's easier to get approved. Okay.
What is usually the interest on the 7A loan program?
It depends on the market. Okay. I mean right now it's in the 4s. You know what I'm saying? 4.5. Okay, 5. No, actually maybe in the 5s. Right now it's probably in the 5s. Okay, 4 or 5s, okay? The 504 program, okay, are normally larger loans. The 504 program is normally a larger loan, okay? It's more commonly used to fund real estate, okay, or a large equipment, okay? All right, it goes through, it's more heavily regulated, okay? More heavily regulated means that, you know, it's not as flexible. The parameters in which they lend you are more strict. You know, you have a more solid business. But if you can get it, okay, you can get low interest rates and terms up to 10, 25-year terms.
And down payment on it also 10%?
Yeah, both are around 10%. Okay, all right. So these loans are like piggyback loans. All right. Technically, the SBA portion of the loan is around 40% of what you borrow in whole. And then the bank funds the other 60%. Make sense? So if you went directly to the bank, they just give you 60%. Then you'd have to come up with the other 40%. But instead, you go through SBA, you only put 10% of your money. And so it's like a combination of a normal bank and a bridge bank put together, right?
Right.
But not with crazy interest rates.
One payment?
Huh? Yeah, you still make your own payment, okay? So you like it?
Yes.
It's longer term too, then you can refinance
Yeah,
it.
and it's longer. Yeah, it's less penalties. Yeah, so it's good. It's good. I mean, SBA is a good loan. You know, SBA loans. I mean, it's great for doctors because doctors. It's great for the professionals. Like doctors, like chiropractors, you know, engineering companies, law firms. It's great for them, okay? Because not only are they borrowing money for the real estate, they're borrowing money for all their equipment. They're even borrowing money for the systems they need. You know what I'm saying? Even spending money. Even you know what I'm saying?
They're borrowing for all this equipment, like doctor's equipment is very
Yeah,
expensive.
that's what I'm saying. So like for example, let's say for example, a building that the doctor wants to buy is $3 million, and the equipment costs another $2 million. So he put 10% down on $5 million, 500 grand, and they'll lend the 4.5 million. You see, it's great for them. Great, absolutely wonderful. So this is SBA, just the two programs. The 7A program is more flexible. More people can get it. It's the most common type, okay? Because the people that go for those loan programs, sometimes they're new business owners. You know, they don't have all the world's best financials yet. You know what I'm saying? Eventually they will, but hopefully. But so those are the two programs. There's a 7A and the 504.
So
We usually
it
fund
would be nice.
SBA.
Huh?
We usually fund the funds coming from the SBA loans.
No, well, 60% of it comes from the bank direct, and the other 40% comes from SBA. Okay?
It work for agriculture too?
Huh?
Agriculture too?
Depends, you know. Okay. Well, not really agriculture, but well, sometimes there's programs for it. All right. Okay. Next. So how to qualify. This just talks about that. Okay. Equipment financing. I don't want to go through that. We don't really do a lot of equipment financing, even though we can. The normal commercial real estate loan. Let's see. Business lines of credit. Well, another line of credit is a business line of credit. This is simple. This is. Okay, so under the business lines of credit, you might run into this. We don't really do any of that, okay? But at least you know about the loan program if the client asks. There's some clients, they just need a business line of credit. And a business line of credit is just a credit line for your business. You know, if you need one, you could just go straight to your bank or straight to, even your credit card companies have business lines of credit they could get, okay? And that's just working capital. They're normally non-secured. They're secured against your business, but not secured against your real estate. This is normal business lines of credit. And finally, the last type of loan is called merchant cash advances. We don't do those either. Okay, but merchant cash advances are for companies that collect a lot of money in credit cards. And so you borrow based on how much money you collect in credit cards. And they're pretty high interest rates. Okay? These are just for businesses like restaurants that need to get money to put new kitchen equipment in there or something. They're called merchant cash advances. That's all. All right, so let's go into the more meats and potatoes of what we need to collect. So, Junie, can you pull it up for me? All right. Let's go into the checklist first. The checklist. Oh, we don't need a cover sheet. Just the checklist. Okay, let's open that up. All right. So these are some of the things that normally our company, this is our commercial loan division, ERS nationwide. Okay, we are a California finance lender. All right, but of course, Leap Mortgage has it too. We're also Leap Mortgage. All right, so these are eventually the things that we need to collect from every client. Okay, you can take a picture of that if you'd like. Okay. Because I don't think you would want to take a picture of it all. I mean, write all those things down. So you take a picture of it if you like. Okay? Okay, so I'll go in with you. So when you say, hey, Robert, I have a client who needs a commercial loan. What do I need to collect? It's actually fairly simple because you don't need to collect all of that up front. Okay? Okay, number one, eventually we will though. Number one is a fee agreement. The fee agreement is the agreement in which they understand that if we're helping them with this loan, that we don't do it for free. Okay? Normally, when we are doing a residential loan, we get paid one of two ways. We call it lender paid or borrower paid. If we go lender paid, then as we do the loan for the client, the lender pays us. If the client wants an extremely good rate, they could go what we call borrower paid and buy their rates down. And in that case, we'd give them a par pricing, which is we don't make anything from the bank, and they pay us instead of the lender, right? So it's called lender paid or borrower paid. That's it. Well, in this industry, it's all borrower paid. There's really no such thing as lender paid. Okay? There's only on one instance where we also get lender paid. And that instance is on SBA financing. Okay, on SBA financing, all right, we do get points from the SBA portion of the loan if we worked with one of our wholesale lenders. Does that make sense? I'll give you an example of what I mean by that. It's not uncommon for us to do an SBA loan. When we do an SBA loan, we charge our clients, say, 1%. Okay? If we're doing an SBA loan where, let's say, example, the SBA portion is $3 million and the bank portion is $5 million, so the total loan amount is $8 million. The fee that we charge is 1% of the complete loan amount. So I mean, I'm just giving you an example, 1%, 2%. So let's say we charge 1% of the loan amount, then 3 million and 5 million is 8 million, 1% of that is $80,000. That's the fee that we charge. The bank puts it on their the fee sheet, client, and it's paid by the funds, okay? Make sense?
Yeah.
So we charge our 1%. But if it was SBA will generally make 1% from the SBA portion as well. And so that 1% from SBA portion, so 1% of 3 million is another 30,000. So you'll make your 1% in general, but then we could get paid another 1% just from the SBA portion. Make sense?
Yes.
Okay, from the wholesaler. All right, you guys get that? So when the check comes, it's the 80 plus the 30, it's 110. Not bad, right?
Good money.
Yeah, so that's how it works, okay? But it's not the 3% or 2% and 2.5% that the commercial brokers get. The commercial broker's commission, if you're at 3% on a $10 million deal, is $300,000. You know what I'm saying? Okay, but that's the world you're in. When you're in commercial, and when you're in commercial industry, that's the world you're in. Okay?
The 1% is fixed regardless of loan amount.
What?
1% is
No. It depends on what you agree with your client. I have loan officers that charge 3%. Okay? But pretty common is 1 to 2%. Not 3%. Okay? So the first agreement we have is the fee agreement. Second one is a certification authorization form. That's if we're the ones running the credit. If we're the ones running the credit. Okay? Sometimes if we know the client, we don't run the credit. The reason why is the bank that we submit to, they'll run the credit too. And they won't take our credit report. So the only time that we run the credit is if we're not sure about the client, if we even want to work with them. Then we'll just run it. You know what I'm saying? And so that's the authorization form is for us to run the credit. Okay, but normally we wouldn't run the credit. On residential, we run the credit every time. We don't want to work with people we don't know, right? But the lenders, they use our credit report that we ran. And then at the very end, they'll run their own final supplement just to verify, right? But our lender, the banks that we work with, they run their own credit. Okay, all right. Next form is just a transaction contact form. That's just for us to know who to contact for what. The next form we have is a commercial loan application. I'm going to be going over with you that pretty soon here. The next one is the business financial statement form, an individual financial statement form. Okay. Individual financial statement is actually called the personal financial statement, but they call it individual, but it's actually the personal financial statement. So if you ever see if someone saying, hey, I need the PFS, PFS just stands for personal financial statement, okay? All right, in a minute here, I'm going to show you how to fill it out. All right, I'm going to show you how to fill it out. All right, we need the schedule of real estate owned, P&L, profit and loss, current year P&L, current year balance sheet, the IRS 4506T form, which is the form that we need to verify that whatever the information they give us is true. So they will verify it with IRS. Okay. I mean, it's like we fill out a loan application saying the client makes $800,000 a year. They run the 4506T and it shows that they filed a loss. It's like, wait, the bank will decline you right away. All right. Normally, and this is important to know, is normally whenever we do a loan for a client, we always collect 3 years tax returns for the business and for the individual. For business and individual, 3 years tax returns, 3 months bank statements, individual and business bank statements for all business accounts and personal accounts. The borrower executive summary, that's why I told you before, we always collect that. Basically, it's a summary of why we're needing to borrow the money and what's the project, okay? It's a summary of that. Okay, and proof of residency. And then, and don't worry about these two, authorization to run credit and authorization to order appraisal. That's normally, okay. When we do a loan with the bank, expect them to ask for, when we submit it to the bank, expect them to ask for a $500 to $7,500 check. Expect them to ask your client for that. Okay? If they ask for a $7,000 check, normally only like $2,500 of it or $3,000 is their initial processing fee to get their company to start looking at it and processing it. Okay, is their underwriting to start looking at it and processing it for a committee to review. But they normally collect the money for their appraisal and environmental up front, so they know that you have the money.
Non-refundable.
Non-refundable. Okay, So because there will be a phase 1 environmental report that's always ordered on a commercial, okay, and there's always going to be an appraisal. Appraisal, environmental report normally costs $2,500. Appraisal normally costs $4,000 to $5,000. So don't be surprised if they ask for those fees up front. They're not going to start working with you when your butt don't even put anything up front. Does that make sense? You guys understand that? Okay, so I want you to understand it. Okay, so go to the next slide. Let's go to the, project summary questionnaire. Let's go to the fee. Let's just go to the fee agreement first. Number 3. Yeah. So I'll give you just a sample of what it looks like. This is our fee agreement. What it looks like. All it is it's just our agreement with the client saying that they agree that if we help them with the loan, this is what they're going to pay us. That's all. Okay, that's all it is, just a fee agreement. Okay, let's go to the next one. I don't have a lot of time, so I have to start moving here. I only have 30 minutes. Okay, so all right. So the next one is a property summary questionnaire. Normally, if you ever come to us and say, "Hey, I have a client. They want to buy a commercial building. We sort of, want to try to do the loan, okay? Then what I will do is I will send you this package, all right? And you have to talk to me about it, and I'll send you this package, and you start just filling it out for me, okay? Again, on these deals, we split it, and I help you with that. But all this is just basically what type of loan is it? Is it for mixed use? What are you trying to look for? Briefly describe. Now, this is not your executive summary, but it sort of helps us. So as we send this to a bank, they'll sort of look at it, and then eventually you'll need an executive summary, okay? All right, so that's what that is. Okay, let's keep going. Next one. Next slide. Okay. This was just the authorization for us to verify their stuff. Okay, that's all. All right, next. This is just an authorization for us to verify their information. Okay, all right. Okay, this is just all the contact information, that's all. Okay, and then so, like for example here, I'll just go over this real fast. This is where I asked them, well, what's your CPA's information? Are you working with an attorney? Are you doing an exchange? Are you working with an insurance professional, financial planner, real estate professional? That's all. It's just us to help us, organize who's who on this transaction. That's all. Okay? All right. And then next one. Okay, next one. Okay. Commercial loan application. So this is, I'm just going to go over with you. This is what a commercial loan application looks like. Okay? Very professional. All right, so when we work with a client, we need them to fill this out. It's our commercial loan application. Okay? We use this loan application and we'll send it to whatever bank. Okay? All right? So I'll go over with you a little bit here. First one, amount requested, terms of credit requested. So let's say, for example, if we have an idea that you're buying the shopping center for $10 million, and you're looking for, a shopping center, you don't get SBA because that's not, one of the things I think I mentioned before, but I forgot to mention today, is SBA has to be owner-occupied. You got to owner-occupy at least 51% of the building. Okay? You don't have to owner-occupy at all, but you have to owner-occupy more than half. Make sense? Okay? So let's say, for example, if you're buying a shopping center and you're putting 30% down and you're looking for a $7 million loan, you put it in there, I'm looking for a $7 million loan, term of credit, put in there fixed, 10 years, whatever, okay? Type of loan, this will be, let's say a purchase, so you put purchase on the bottom there, ownership percentage, 100%, purpose of credit, purchase, any judgments, no, okay? Credit only, there's joint or applicant only. This is where if there's you and the wife are buying it, only you, whatever it is, okay? All right, then it says, okay, who the applicant is, the borrower or guarantor, okay, the cosigner, okay? And then you just fill out that information. If it's like two individuals buying it together, then I need an application for both people, okay? All right. Then I'll ask, just ask, are you relying on your own income or assets? Are you applying for individual credit? What are you really applying for? Are you married? What your address is? What kind of organization are you? So for example, if you are a corporation or you're an LLC, then you'd say, well, the LLC is getting the loan, but I'm going to be a guarantor. So you click guarantor. Make sense? If you buy it as an individual, then you're the individual. But if you buy it as a corporation or LLC, and there's 4 of you all applying for the loan, then you click that we're an LLC, and every person would click on its guarantor. Make sense? You don't have to be absolutely accurate as far as marking the right box or whatever, because once you actually find the lender's going to send us this application if they want it on their form. Does that make sense? And so you might have to do it again anyways, okay? But this gets everything started, okay? So then it's going to say, well, what's the description? Say, hey, this is the address of the shopping center. It's $10 million shopping center, 45,000 square feet shopping center. The value's $10 million. I'm looking for a $7 million loan, right? And then who owes the money? Okay. Now, as we go down, it's going to say, hey, we're a new customer. Okay, so this basically just says, have you used them as a lender before? Yes or no, that's all. Okay? Okay, talks about the business. How many years have you been in business? Have you had any bankruptcies, any judgments in the business? That kind of information. Okay, and list all the guarantors. Okay, so if this is an LLC, and there's 4 people in the LLC, you list the other 3 people here. So they know to put the applications in together. Does that make sense? And that's it. You just sign, date, for lender's information, and it's actually a pretty simple form. Okay, it's actually shorter than our own residential loan application. All right, it's a pretty simple form. All right, so just fill it out. Okay, just fill it out. All right, the next one is the business financial statement and your personal financial statement. Okay, again, and the ones we have is fillable, so it's professional. But again, let's go up to the top here. This is the business one you fill in. So let's say, for example, your business is applying for. You have a business. You put your business information, the name of your business. Your name, your business name, and what your business has. Okay, so basically this is how it's filled in. Normally, you would do one for your business. If all your assets are owned by yourself, then you just do one for your personal. Okay, but just ask questions like cash on hand is how much money you have in the bank, how much money you have in savings, retirement accounts. If you have an insurance policy that has a surrender value, stocks, bonds, real estate, okay, what assets you own for cars, personal, and then you total it up and you put it right there, okay, and then of course, and then no, stay there, and then the next side is your liabilities. So when you put in your schedule of real estate, you put in gross what everything is worth. And then on this side, you put in there, so let's say you own $1 million in real estate, but of the $1 million you own in real estate, fair market value, you owe $500,000. So on this side in real estate, you own $1 million in real estate, but then on this side, where it says mortgages on real estate, you put $500,000. That make sense? Okay? And then so this asks you what all your liabilities are, monies you owe, and then you take your total assets, you minus your total liabilities, and you get the net worth number. You get your net worth number. Okay? And then they see that. Okay? They see that. They want your business to have the capacity to guarantee this loan. Okay? If you have a high net worth, then doing a loan for you is a lot easier. If you worth nothing, then doing a loan for you is going to be very difficult. Okay? All right? If you owe more, if you're negative, then you shouldn't be on the loan. Okay? Then you should be on the loan. All right? Next one, this is just talks about your source of income. If you have any contingent liabilities, like claims and judgments, and then the next pages break down all of your other assets and debts. So the first one is if you owe any money to the banks. Next one is if you own any kind of stock. Next one is if you own real estate. Okay, like I have clients who own more than 3 properties. So what we do is you see those items, type of property, address, date, purchase, original cost. You see all those categories? All you do is you take all those categories, you put it on an Excel spreadsheet, same exact category. That's the categories that you want. You put it on a spreadsheet, you make a whole spreadsheet of it. Does that make sense? You'll make a whole spreadsheet. All right? And I have the spreadsheet already blank. So I can just send it to you and just fill in the blank. Okay? All right? And then, of course, this is where you describe your other assets, describe certain things. You know what I'm saying? If you say, hey, I have $1 million worth of assets. So then you have to, this is where you describe, well, you said $1 million worth of assets. What is it? You describe it. Okay, we have jewelry, we have this and that, whatever. Okay? And then you sign. So it's just a 2-page, 2-3-page form. It's pretty easy. Okay? It's pretty easy. So open the next one, the individual. So this is the individual one. So let's say, for example, your LLC is buying a building, and your LLC comprises of 4 people. So I need a personal financial statement, individual one or personal one. Okay, I need it for all 4 people. And then I need one separate one for the business itself. And the LLC might not have a lot of assets, or might already own 2 or 3 buildings. Does that make sense? So I need it for the individuals, and I need it for the business. Okay. So this is an individual financial statement. All right. Ask the same exact questions. Not that hard to do, right? Not that hard to do. Okay. Okay, so let's keep going here. Next one. Here is that form that I created for you already. Schedule of real estate owned. Okay? But it's a more detailed one, actually. So it's already, so you see our company, we already have everything put in place already. Okay, so you type it right in. So this is a schedule of real estate owned. Okay. Next one is the 4506T. This is what the tax transcript is. Just an authorization for the bank to pull a tax transcript. Okay, so here. This is what we give to them that says, this is a borrow executive summary, what we're looking for. Okay, so we need a history of the principals involved in the transaction. Okay, be sure to include projects you've done in the past, what you've owned in the past, what kind of experience you have. Because whoever's lending you the money, they want to know. If you're building a shopping center and you say, well, I'm a landscaper, my wife is a teacher, and I want to buy this retail shopping center. It's like, what? You want us to lend you $10 million and you've never done anything before? Or hey, this is we own 3 other shopping centers. We want to buy another shopping center. We're experienced investors. So if there's something good, that this is where. So the first paragraph is a history of the principals. Second paragraph is description of the subject property and the current condition. So we want to buy this $10 million shopping center. It's on a very busy street off Elk Grove Boulevard. The shopping center is only 15 years old. It's 85%, 95% occupied. It has currently a Jamba Juice, a Starbucks. I'm like, right? Okay. You know, if repairs are needed, hey, we're buying it as an income property. We're willing to put $3 million down. We need $7 million. It cash flows. You know, that kind of stuff, okay? Okay, brief description of the market in which the subject property is located. Okay, this is in Elk Grove. Elk Grove is a growing community. And of course, their broker should provide them with market data, okay? It's easy. It's easy. We can pull it up anytime. I could go to CoStar, pull it up right away. Okay, of the demographics. So, you know, how many properties are like that? Likelihood of more properties being built in the area. Hey, there's a new casino coming. That's why we want to buy that shopping center. There's a new casino coming. It's going to bring 5,000 new jobs. It's going to, you know what I'm saying? That kind of stuff. Okay. And then describe what kind of loan you're looking for. I'm just looking for a purchase loan. You know, we also want to, you know, put some money into fixing it up, so we're looking for some extra money there. That's why we're only, you know, we're looking for a 70% LTV, and then that's it. Okay? So this is a little bit of a tutorial for you to give to the client. Say, hey client, can you write me 3 paragraphs, and I'll help you with that. And then this is what we use to give as an executive summary. Make sense? Not too bad, right? Okay, next one. This is just us running their credit, that's all. This is just a form that allows us to run their credit, all right? If you're working with a big client, you know, you don't have to get their credit card information. And then this is authorization to get an appraisal, but no, we don't even need that because normally the banks that we work with will collect a check for that amount, okay? So that's the commercial lending packet. Is it professional?
Yes.
Very professional, very simple. It's not that hard to do.
Can we get that in the email?
Huh?
Can we get the package in the email?
Not until you're ready. Okay? All right. And then that's it. So we have that. Okay? So when you have a deal, you call me first, talk to me about the deal, and then I'll send you the packet and say, hey, get this and this and this completed. Okay? And then I'll send it to my wholesaler and see what they have. All right? Okay? There are deals that are more complex. If the deal is more complex, I send it to my contact, and they do the deal, and they split their fee with us. Okay? But then you don't have to do anything. Me either. You know? We just have to sort of follow up a little bit. So if the deal is pretty straightforward, we'll do it. But the deal is a little bit more complex. They're a church. You know, they're a development. They're a... You know what I'm saying? Then there's a lot of moving pieces to it. The pieces keep moving. Then I just send it to someone myself too. Make sense? Okay, if it's really complex. All right? So that's what I do. Okay, so that's that package right there. How are we doing on time here? 20 minutes. Any questions?
We can buy property with the IRA money too or no?
A what?
You have an individual retirement account. We can use that money too as a down payment.
Yeah, I mean, as long as you can take it out, you can use money from anything, even from your mattress at home.
Do you work with the bigger banks like Bank of the West?
Yeah,
Yeah.
yeah. We work with them all. I mean, the ones that we don't really work. Well, if we had to send a deal to a big box bank, our clients still have to pay us. But some of those banks, they'll still charge a client a little bit, okay? You know, but, so sometimes if the loan is pretty small and straightforward, like for example, just so you know, normally we don't touch a loan that's under $1 million, okay? And a lot of our big banks, they won't touch it if it's under $1 million. So if you're looking for like a small $300,000, $400,000, $500,000 loan, then sometimes it's actually better for them just to go directly to their bank and just tell them, yeah, sometimes better directly go to your bank. Because the lender, like the big banks like Zion, these big banks, they won't even look at a deal that's under $1 million. Really, it's not worth their time. Because the amount of work they have to get approved and the committees they have to go through are the same, you know? You guys understand that? Okay, so it's not really worth it, you know, for them. The deal is worth it because you make 3%, but in commercial financing, unless sometimes we're only working on 1%, you know, a deal that's $300,000 deal, you make $3,000, it's not even worth handling. You know what I'm saying? Handling. You know, I mean, we had a deal come to the company where it's so funny. You know, the guy has a friend and the family member, and because they say, okay, well then I'm just gonna charge you $1,000 to list your home. And I told him, if you're gonna do that, then just have them for sale by owner. Don't even take it through the company. You know what I'm saying? Because you have all the same responsibility, all the same risk. Everything is the same. You know, but you do it for nothing. You know, it's like it's better not even do it, or do it as a friend. You know, provide them, you know, guidance, but don't charge them for it. You know what I'm saying? Don't charge them for it because don't even run it through the company for $500. Why don't even run it through the company? You know what I'm saying? Because like there's everything. Everything you held to the same standard. You know, right? You held to the same standard, so don't even do it. Okay.
But if you don't do any loan for the church, yes, because the deal that I'm doing right now is church.
Oh yeah, we have deals with churches. But for a church deal, I would send it straight to my guy.
Okay.
Yeah, and he just gives us a fee. You know what I'm saying? I'll send it straight to my guy, and then because so if there's like special kind of stuff, I have someone who's been in the business for 25 years, and he does everything. He knows how to do anything. Okay, and so working with him, if he can't do it, no one can do it. You know, and so if it's like a little bit odd, I'll just send it right to him and say, hey, you do it. You know what I'm saying? And he'll split his fee with us, but he'll do it. You know, you don't have to touch it. He'll meet with the client. He'll gather everything. Yeah, he'll do it. You know, and we don't have to touch it. Yeah. All right. So next week we're just going to cover all the things that tie all the loose ends. You know, one of the loose ends that I want to cover is a whole section on due diligence that I didn't have a chance to cover last week. Okay, I'm going to cover next week basically the commercial real estate jargon. You know, that go over the glossary of terms with you. Okay, so next week is almost like a finals prep. All right, it's me preparing you for your exam. Okay, so I in my notes I already know what I'm going to cover next week. We didn't have a chance to cover it, you know. So just next week will probably be the very last week in commercial training. Okay, on the 24th, our exam is going to start at 10, and I will not send the exam for you to take it home. Okay, so for you, those of you who are online, be here for your exam. Okay. But at the same time, I'm going to make the time worth it for you, is because we're going to mix in there a compliance meeting as well, and we have a special presentation on the 24th that deals with non-QM financing. So you should be able to learn how to make a lot more clients qualify. Okay, you know, one of the things that lady, one of the trainers said is that, you know, we approved 9 out of 10 people that were disapproved before. We approved 9 out of 10 people that come through our door. And these are all turn downs, okay? We approved 9 out of 10 turn downs. You got to be really, really bad for us to turn you down, okay? So that's what they said. So I'm taking their word for it, all right?
They
So,
have to do with the commercial lending, right?
what?
They are the commercial lenders.
No, they're residential. No, they're residential, okay? They're residential. So I'll help you work with many more types of clients, okay? All right, let's see what other things we need to cover. And that's basically it, okay? So do not miss out next week, because next week's our finals review and cover the things that we needed to cover. And then lunch is provided on the 24th as well, okay? And that's it. So I'll see you guys next week for our finals review.